Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome to Phil's Tax Hacks and Other Retirement Facts. Mark and Phil back once again to talk investing, finance, and retirement. And Phil, let's go through top 10 tax questions for retirees in 2023. You are in the midst of it, right?
We are in the midst of it. That is for sure. So
yeah, you're full on.
Everyone's finally got all their documents, I think, except for those few lingering 1099s that always come in late. But
Right. Yep. So what I want to do is I want to try, there's quite a bit here. I want to try to blow through these and try to give some people some things to think about. Obviously, if you need more details, definitely reach out to Phil. But these are just some ideas for you to think about talking with your CPA or talking with your financial advisor. And of course, Phil is both of those things. So let's jump in and we'll break down a few of these things. Again, some top questions for folks to ponder for 2023. Number one, what are the tax implications, Phil, of withdrawing money from retirement accounts? That's sometimes something that people overlook. We save money in these buckets, but which ones, like, how do they affect us tax-wise?
Yeah, so, I mean, that can be kind of a loaded question. The reality is, if you think of it kind of the normal way, you're in whatever your marginal bracket is, the 10, 12, 22, 24, whatever, based on income.
Right.
So for instance, married couple this year is around 83 taxable. You're above that. Now you're into the 22% bracket, below that into 12. That's kind of that threshold. So you would think, oh, that's 10 or 12 or maybe 22% federal, and then whatever your state tax is.
Right.
So that's kind of in its simplistic form what it could be. The challenge with that, though, is that, and we'll get into number two when you talk about Social Security, is that when you blend Social Security income with that RMD or income from the IRA account, all of a sudden your taxes effectively end up going up just because of how the formula for taxation of Social Security works.
Well, how you pull and where you pull, correct, from the accounts, it is important because it will affect number two, which is, will my Social Security be taxed?
Right.
Possibly, right?
Yeah. And it's, for most people, it is taxed at some level, and it's ranging anywhere between 50 and 85% is kind of the threshold you go through. I mean, the reality is, if you look at it from a percentage of your total, it can be 0 up to 85, but the two tiers you go through is a 50% threshold, then an 85% threshold. And as your provisional income, which is basically all your income, including tax exempt interest, and then just half of the Social Security income or benefit is that provisional income. So that's the threshold that the IRS uses to determine how much of that Social Security benefit then becomes taxable. So that's what I said. And that's where it gets to be really kind of crazy math, that as you get above these top thresholds, for instance, married, 44,000 is provisional income. Once you get above that, for every dollar above that, 85 cents of your Social Security benefit becomes taxable.
Yeah. And that's not a tax bracket, folks.
It's not a tax bracket. I always joke and say they're greedy, but they're not that greedy. It's not, it's not 85% taxable. But I mean, if you had, another $1,000 of IRA distributions and you're just in the 12% bracket, well, because of that $1,000, you're getting taxed on the $1,000 of IRA, as well as another $850 of Social Security. So you didn't get any more Social Security benefit. You just have the privilege now of paying tax on another $850 because of the $1,000 that came out.
You're welcome.
So, yeah, it's one of those kind of a goofy math formulas. So you got to be really careful and plan it out. One of the reasons we do Roth conversions is, depending on how you shift and position those
lower
buckets,
the taxable income, right?
Yeah. If we can change the mix and makeup of your income so that it's a larger percentage from Social Security and then less from IRAs, pensions, those kind of income, even blend in the Roth, now we can drop down the taxation of Social Security and change your whole tax picture long term.
So 1 and 2 definitely play
hand in hand. Yep.
Okay. Yep. All right. Number 3, pensions. Is that a state by state? Is there a federal thing?
So for
get taxed
for federal, it's ordinary income. So I mean, it's going to be taxed at whatever your bracket, 10, 12, 22, et cetera. For states, it's a state by state, depending, some states it's based on if it's a state pension. For Michigan, they've changed this rule several times. And in fact, they're in the middle of changing it again. I think kind of walking back some of the things they used to be more generous on pensions, especially for state pensions. It was not taxed. So Again, that's going to be a state by state. Just understand what your state is, but from a federal, it's ordinary income.
Okay. All right.
So
Number 4, the Secure Act. How might it affect retirement income taxes? I will say that, Phil, we just did at the beginning
yeah,
of the year, just a few weeks back, a
yep,
two-parter on the new Secure Act changes. But
right.
quickly, this is probably what, RMDs?
Yeah, I mean, probably the biggest piece out of it that you would want to look at for taxes is RMDs. Them pushing that RMD age out now to 73 or 75 if you're born in 1959 or after. So,
Okay. Right. Yeah.
yep,
And again, if you want to get really into the nitty gritty, folks, go check out the two-parter we did.
yep,
Just a
it'll have
couple
all
weeks
the ins
ago.
and outs on it, and yeah,
Yeah, absolutely. And we can put up a link in the show description as well.
sure.
To make it easy for you. All right. So the number 5, are there any special tax deductions or credits available for retirees?
Not really. I mean, it's usually you get into retirements, a lot of the deductions end up going away. The standard deduction is the best option. Credits, the residential energy credit. I mean, there's some, credits out there for like home improvements that are energy efficient,
Right.
pretty small, so nothing major. But yeah,
Right.
nothing specifically for retirees per se.
No disability type of things or anything?
No,
Okay. Because we're in the current tax bracket, we really can't. Most people they can't, but most people just aren't doing the itemized because.
Correct. Yeah. I mean, most people with the current standard deduction at where it's at today, it doesn't make sense. You don't have enough. It's such a high hurdle to try to get over.
That could change
So,
in 26.
well, it is. Yeah. It's slated to
back.
change. So, I mean, unless
Right.
Congress acts and changes what's on the books today, it's all going to go back to what it was. And standard
And
deduction
then maybe that answer changes.
Yep, exactly. That, standard deduction gets cut back, personal exemptions come back. So, I mean,
Okay.
now we're back
All right.
into planning for itemized again, maybe.
Okay.
So,
Yeah. So something to at least think about in the future radar for
Mhm.
sure. Okay. So here's an interesting one. Now, a lot of Michiganders,
Mhm.
which is obviously where your office is based. Of course, you've got clients everywhere, but people in general, we've seen quite the mass exodus from many a high tax state
Yep.
to lower tax states. So number 6, is that something to consider, like how that might affect your tax strategy if you you were just in Florida, for example?
Absolutely. Yeah. I mean, it's a consideration. I mean, I had that discussion often with clients, especially if they've already got a second home, maybe a vacation home in Florida. It's for Michiganders pretty common. Florida doesn't have an income tax,
Right, but it's gotta
obviously
be your
Michigan
main-
does.
Yeah.
But I mean, they have higher sales tax, and then you get into county sales taxes too, and it's a whole. You got to look at beyond just the income tax because there's the property
It's got to
tax
be your
component.
main. It's got to be your main residence, though. They don't.
Oh, absolutely, yeah. And
Yeah.
it's not, you can't just pick and choose. There's a bunch of hurdles you got to go through to
Yeah.
qualify, quote unquote. You've got to. Bottom line, it has to be your primary residence. Spend the majority of your time there, so more than 6 months.
Yeah.
And Florida has become pretty difficult at this. They want to make sure this is your residence. So,
Well, sure, everybody
they're-
goes there, so they right.
yeah. So I mean,
like, wait a minute.
they're not just going to let you check the box and say, "Yep, I'm a resident."
Yeah.
They want to see the details. Show me the utility bills, the driver's license, the whole gamut. So,
Oh yeah, that's a
but
good
can it
point.
be worth it? Yeah. I mean, if we've got a lot of clients, we do Roth conversions, and I mean, if you're converting $100,000 and Michigan's paying, you pay them 4.25%.
Sure.
$4,000 to change to be a Florida resident. I mean, again, as long as it qualifies and
Yeah.
you meet all the requirements. So
It could be
maybe
a
stay an
possibility.
extra a month in Florida to kind of swing the bar that direction. And so, yeah,
Yeah. See, a month in Florida, a month with potholes, and
that's right.
although
Especially this time of year, a month in Florida
although all traffic is just as bad in both places, though. So
it's
both
horrendous.
places, traffic is terrible. All right. So number 7.
Mhm.
Charitable contributions, tax benefits there. Again, does that kind of hit us because of where we're at with the whole deduction thing now? Or?
Yeah, I mean, that really gets back into that itemized deduction thing. They had the last couple of years with COVID, either an additional 300 or 600 for married couples that you could take for charity in addition to your standard, but they did away with that this year.
Yeah.
That was kind of a COVID special for charities to try to help encourage people to still do their donations. But yeah, charitable planning, there's a whole gamut we can get into beyond that. If you are charitably inclined, one consideration, and we work with clients in this a lot, is using what's called a donor advised fund or some other kind of a charitable trust where we can accelerate and do large contributions in 1 year. So it gets them way over the threshold. Now they qualify and get the deduction.
Right.
And then now in the future, make your contributions out of that charitable trust or donor advised fund. And then you're below the threshold, it doesn't matter anyway. So, I mean, there's ways around it. Qualified charitable distributions out of your IRA, that's another one.
Yep.
So once you're 70 and a half, if you are charitably inclined, no longer a reason to pay for charity out of your normal checking account or savings, pay for it out of the IRAs, because now it's not income to you, counts as a required minimum distribution.
It goes back to that top one. It helps that top income level. Plus it also helps the RMD.
Yep.
So yeah.
Yeah. I mean, you weren't getting the deduction anyways, because you weren't above the threshold. So it helps check a lot of the boxes off. So so if you are charitably inclined, make sure you have that discussion, because there are ways to incorporate that into your plan and not technically get the deduction maybe, but have it work out for your benefits. So.
And that's what I was going to say. So I'm glad you brought that up, but it doesn't, you've got a plan. I mean, you've got to strategize to get this to happen. So like any of these, we just don't kind of get to fall into them for the most part. We have to really kind of work at some of this stuff. Number 8, tax considerations for gifting money. Mm-hmm. Kids, grandkids. I know what is it? What, 17,000?
Yeah, something like that. I mean, there's no real tax considerations necessarily. I mean, there's no benefit. They're not. I always joke with my clients, they're not a charity. As much as they may seem like sometimes. You don't get a charity deduction.
Does that lower your income though?
It doesn't lower income. There's no deduction for it. I mean, it basically is just removes it from the estate. And so the whole gifting side of it really relates to estate tax.
Okay. Which right now is still really
that's
high.
Why it's there. They don't want somebody to give away everything to avoid estate tax.
Yeah.
But that's the purpose, is there's this threshold. So even if you're above that, you might have to file a quote unquote gift tax return, but that doesn't mean you're paying tax. All that does is you're using a portion of your lifetime, 13 or 15 million, whatever it is today, of your exclusion, right? Your exemption. Which for most people, it's not even a concern or issue. You're never going to get there anyway. So, yeah. So, I mean, it's from an income tax standpoint, there is no ramification, no benefit.
All right, Phil. So number 9, are there any tax issues with starting a smaller side business, a side hustle, as we like to say right now,
Yeah, which that's become a real popular gig, so to speak, in COVID with, whoever, retirees or not. Is there any tax ramifications? No, I mean, it can be a benefit. I mean, anytime you have a side business, obviously depends on your specific scenario, but any items you're using for that business, like your cell phone, your internet, computers, depending on what that business is, travel. I mean, there's a lot of things that could come into that could be deductible. Another piece that often
you got to have money coming in.
But you have to have money coming in, right? I mean, you can't have this loss every year. I mean, there's what they call the hobby loss rules, right? So you can't have a quote unquote hobby that you generate a little revenue from, but you lose money every year. There's got to be a profit.
You can probably do a couple of years, but after that,
I mean, they look at 3 out of 5. Is kind of the general rule. I mean, it's not a hard and set rule where they're monitoring it, and that 3rd year you better be making money.
Right.
It's just a general rule that they come back to, that if you're continuously losing money, at some point you're probably going to get caught, and they're going to say, okay, wait a minute, is this a hobby? Is there profit motive? Why are you doing this? And at the end of the day, there has to be profit motive.
Yeah.
And the other piece is going to be Medicare premiums, so once you're in a business, now technically your Medicare premiums can be considered self-employed health insurance.
Okay.
So that takes that itemized deduction, which most people don't qualify for medical itemized anyways, and throws it above the line.
Right.
So there could be some benefit there. So,
okay. And then finally, number 10, I said top 10, dealer's choice. What have you got that I missed?
I would say dealing with Medicare premiums, that's kind of one of those big gotchas out there that oftentimes people are getting caught off guard, not really realizing what happens. And, they file their tax return, and 2 years later, they get this notice from Medicare saying, oh, by the way, your new Medicare premium for this year is double what it is for, your normal premium.
Oh,
you just have to be very conscious of, doing Roth conversions, whatever it is, that as your modified adjusted gross income, they call it. So basically your front page income plus tax exempt interest, once that gets above certain tiers, for married versus single, now you start to pay additional Medicare premium.
And that's what bumps you up when you bump up an income tier.
Well, and yeah, and these are totally different income tiers. So it's not the tax brackets. That's something different.
Okay, so they're another set of numbers. They go
Yeah.
up.
So for instance, for 2023, it's always a 2-year look back, right? So for 23, they were looking at 21's tax return. And the base tier for singles is 97, for married is 194. So if your modified adjusted gross income is below that, you just pay the 164.90, which is the Medicare B premium, and whatever your Part D, your prescription drug premium is.
Gotcha.
As that modified adjusted gross income goes above that, now you start to hit these tiers. And the difference between this and like a tax bracket, with tax brackets, if you go above a tax bracket, it's just that marginal piece, whatever is above.
Right. Yeah.
This, so for instance, married filing joint 194, if you have 194.01, so $1 more, boom, you're in that tier. And now your Part B premium per person went from 164.90 to 230.80 per person.
Yeah.
So I mean, it's just, I treat it like a tax, the way I always look at it, because it's based on income. It's more you have to pay.
Sure.
Just understand it, especially if you're doing some planning, Roth conversions, things like that. And this is always a discussion we have with clients. Hey, if we're doing this, you're going to probably get pushed into these tiers. But the other thing to consider is if you don't do it, what does it look like down the road when RMDs hit and all these other factors? You might end up getting pushed into those tiers later on anyways. So,
okay. Yeah, that's a good one. So yet another good tax tip here from Phil on Phil's Tax Hacks, right? So that's what we're talking about. So, all right, well, we're going to jump out, let you get back on with your day, Phil. Thanks so much for hanging out with us. As always, folks, if you need some help, especially around tax time, but don't forget, it's not just the annual tax prep, right? It's also all year long doing tax planning to be more efficient in retirement as well. So give him a call if you got some questions. Get on the calendar, 248-888-7530. That's 248-888-7530. The number is on the screen as well. Or stop by philstaxhacks.com. That's philstaxhacks.com. Buddy, thanks for hanging out. I'll see you next time.
All right, take care.
We'll catch you next time right here on the podcast. This has been Phil's Tax Hacks and other retirement facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.